How is everyone doing? I was holding off on going live because, as you can see, Jason Raznick is over my shoulder and still alive on the Power Hour, but my show must go on, so here we go. Welcome to the ETF Show, everyone. Spencer Isreal. I'll be joined in a few minutes by Andrew Chanin from ProcureAM. He is the man behind the Space ETF, the Procure Space ETF ticker UFO. But until then, I want to run through a bit of a quarter in review type thing. Obviously, end of the quarters are big deals for managers, for institutions, for allocators in terms of making sure their positions are marked where they should be. They're checking their allocations, and it's a good time to sort of like reset and look back at major trends for the quarter. We spend so much time sort of in the weeds, looking at day-to-day stuff, week-to-week stuff. Let's just zoom out for a minute and just look at just quarterly stuff here. So real quick, before I proceed with that, want to do what I do at the top of every ETF show, which is recap why the hell we're doing this. Why do we even care about ETFs? You know why. It's the same 5 reasons every day, never changes. Diversified, can't talk. Tax efficient, low fees, actively traded, and they're transparent. Usually, those characteristics usually apply. Don't always apply to every single ETF out there, and I'll get to that more in future episodes. But those are the 5 reasons why ETFs are awesome. Some other quick housekeeping before I proceed. I want to remind everyone that I have a ETF knowledge list that actually Andrew Chanin should be on it on Twitter, that I check for ETF knowledge all the time. And I just posted it in chat. There is my ETF knowledge list on Twitter. If you care about such things, check it out. Okay. Long story short, it was a really good quarter for ETFs, specifically US ETFs, but a lot of money. Yeah, I'm sorry. Jason's talking about me, and I hear him. A lot of money went into ETFs last quarter. How much money? Well, let's talk about that. So I'm going to bring up my trusty ETF DB screener tool that I like to utilize, and we're going to go through where the winners and losers were last quarter. Where's my window? There's my window. There it's up. Let's do this. So, at a high level, guys, last quarter was a record quarter for ETFs in terms of flows, in terms of money flowing into ETFs. According to FactSet, a little over $245 billion went into US ETFs last quarter. That's, as I said, a record. All right. A lot of money piling into US funds. What does that mean? It can mean a couple things, right? It could mean there's a lot of money on the sidelines and people don't want dry powder and they're looking for a place to put it. It could mean that people are especially bullish on the US on the US market. It could mean that they weren't in the market all last year and they realized they missed out on the rally and now they want in and they're just playing catch up. We don't really know why these flows go the way they go. We just know that where they go, and they were going into U.S. funds last quarter. Really, I mean, it was pretty evenly broken down. Actually, what's interesting is the flows got better month over month. Right, January saw about $65 billion of inflows. February, $88 billion. March, $90 billion. So more and more money piling into U.S. ETFs as the quarter happened. I would have thought that maybe January was the peak because that was when we had like peak GameStop madness and all that stuff. But no, it turns out January was just the beginning and it got better in terms of inflows February and March. So just a really strong month for US ETFs. And March actually was so strong. I mentioned the $90 billion figure. $90 billion of inflows into US ETFs in March. That basically makes March the second biggest month on record for inflows into US ETFs. So just a huge amount of inflows. I can't say that enough. Let's go into specifics. Let's talk specifics. Which funds saw the most money of inflows last quarter? And I've got my screener here, and I'm going to go to the search tool, and I'm going to start with the biggest gainer in terms of flows, was VOO, the Vanguard S&P 500 ETF, took in about $17 billion of inflows last quarter, which, like I said, was the top of most of any ETF. To put that into context, the fund has, as of the end of the quarter, so this data is a little bit old by now, had about $205 billion in assets. So put that into perspective, about $8 billion of the fund's total assets came into the fund last quarter. You guys know, you all know this one, right? This is super basic stuff. You don't need me to tell you about VOO, right? I am along this one personally. This makes up like a very large amount of my portfolio. I think it's like 40% or something. It's my largest individual holding. I own a lot of VOO. Super basic stuff, right? You don't need me to go too much into that. Number 2, biggest gainers for the quarter, VTI. You really don't need me to explain this. At least I hope not. VOO basically just zoomed out, right? The total, I mean, the name says it all, right? Vanguard total stock market ETF took in a little under $10 billion of inflows last quarter. It's about 4% of the fund's total assets. It's got about $223 billion in assets as of the end of the quarter. Again, so the last few days aren't quite factored into that, but one of the larger ETFs, a lot of inflows last quarter. These two, VOO, VTI, usual suspects, right? Obviously, they're among the largest ETFs on the market, so not a surprise to see these two at the top of the leaderboard. Number 3 is a little bit surprising, not crazy, but XLF. Okay, we were talking this morning about Jamie Dimon's letter, which is out. He's obviously very bullish to the banks, very happy that the banks were able to help out, last year, and in terms of being part of the solution to get us out of the COVID recession, whatever you want to call that, whatever that was last year. XLF took in $9 billion of flows last quarter. That is about 23% of the fund's overall AUM. So a lot of new money, a very large percent of new money coming into XLF, the State Street Financial Select Sector SPDR ETF. Not a total surprise, because this is a pretty thick stock, pretty widely, or ETF, very widely followed, but a little bit of a surprise to see it number 3 in terms of funds with the most inflows last quarter. A lot of new money piling into banks. Let me pull up, here, let me go to Benzinga Pro. I'll show you all a chart. And obviously the banks were beaten down, and we saw value go back into favor, and that's what happened, right? XLF, a lot of time, is a proxy for value in that it's not growth, and you can see just massive run up in XLF in the whole financial sector in the past few months. Maybe people chasing that, but XLF was a big winner with over $9 billion of inflows last quarter. Number 4, again, you do not need me to explain this for you. IVV. This is the iShares BlackRock equivalent of SPY, of VOO. So again, not a surprise to see this. Here's one that's interesting. We talked about U.S. ETFs having a lot of inflows. IEMG, emerging markets. Yeah. Again, not a huge surprise because this is a very large fund, but not all the money was going into strictly U.S. focused funds the last quarter. IEMG took in about $7.5 billion of new inflows in Q1. That's about 10% of its total AUM. So just everyone knows it's not all, the party isn't just in the U.S. Obviously, emerging markets have underperformed. If you zoom out, right, this is no secret, right? U.S. has crushed every other area, every other market around the world. This is not a surprise, but look at that. Kind of speaks for itself. So maybe people chasing, maybe they just want to get out of the U.S. or diversify and allocate in some way. Let me finish this up, and then we'll go into get Andrew on. This one is the money one right here. ARKK. Yeah. For all the crap that Kathy Wood takes, ARKK was the, the 6th, it took in the 6th most amount of money last quarter of any ETF, took in about $6.5 billion of inflows, even though, as you can see, the fund was kind of beaten down. I mean, it went on this huge run. We all know that. It came off the highs in February. A lot of talk about their concentration risk or what would happen. They're so big in these small companies. If they were to ever get a lot of outflows, what could that do to the fund? Well, against all of that, Cathie Wood's our flagship fund took in $6.5 billion. That's about 30% of its current AUM came during the first quarter. All right, real quick, moving on down the list. Number 7, IUSB, right? Super basic iShares total bond market ETF. Not a surprise. Very large fund used a lot by institutions to diversify, allocate to bonds. So not a surprise there. BND, same story, right? IUSB took in about a little over $6 billion last quarter. BND took in about $5.5 billion last quarter. Not a surprise to see these guys on the list. Super large funds. VWO was number 9. This is Vanguard's emerging markets ETF, took in a little over $4.5 billion last quarter. And the last one, value, baby, VTV, the Vanguard Value ETF, took in about $4.6 billion last quarter. That's about a little over 6 and a third percent of the overall AUM in the fund. We talked about that value trade all quarter long, the rotation away from growth into value. At least in February, it's come off a little bit now, but as you can see, VTI as a proxy for value actually is at all-time highs. So yeah, I was a little bit surprised to see this fund up on the top 10 funds with the most inflows last quarter. Again, because it's a large one, but it's value, right? When was the last time value was popular? Usually it's popular for like a week at a time, never for like a month at a time. So those were your biggest AUM gainers in Q1. I will get to AUM losers. Where was the money leaving in the first quarter? But before I do that, I want to bring on my guest. As I mentioned at the top of the show, Andrew Chanin. He is the co-founder and CEO of ProcureAM, launched the first Space Etf. Actually, he's been ahead of several thematic trends. I'll ask him about that, but he's very ahead of the thematic trend and stepped into it more with the launch of UFO. Andrew, how are we doing today?
Thrilled to be here. Thanks for having me.
Yeah. All right. I want to ask you first, UFO has gotten a lot of interest in the last, call it 2 months and change. Basically, what I'm referring to is when Cathie Wood and ARK Invest announced they were launching their own Space ETF, that ended up driving a lot of interest and money into your ETF, did it not?
It certainly seems that way.
What do you make of that?
It's tough to say. I think one thing that that filing did was it brought 2 things. It brought credibility to our concept for a space-themed ETF. In our case, an actual pure play space-themed ETF. And second, and probably most importantly, it brought awareness to investing in space. So all of a sudden, people started looking at space as an investable theme. And UFO had been sitting there for, we're coming up on our 2-year anniversary actually next week of the launch of UFO. And it's something that people can look back, they can see a track record, they can see the companies that have been in and out of the fund, and it brought a lot of attention to, okay, you know what? Space is an investable industry. How do I do it? And we happen to be positioned as a vehicle for investors that wanted instant diversification on a global basis across many pure play names in the space industry with the click of one fund.
All right, and we obviously are not here to critique ARK Invest or anything, but they did take some heat for what some people perceived as having unusual exposure in what is a space ETF. Tell us about your exposure, the exposure that UFO provides.
So we are a passive fund. We track the S Network Space Index. That was co-developed by a former director of research from the Space Foundation, who actually partially built the actual definition of what the space economy is. So anyone that follows the space industry probably reads the space report. He was one of the individuals that actually helped build out the definition of what the space economy is. And so through their research, they drove down to find the companies that are deriving significant amounts of their revenue actually from space. Not a crazy concept if you're doing a space index. And so if you look at the underlying index, a minimum of 80% needs to be dedicated to those companies deriving at least a majority of their revenue from space-related businesses, activities, and services. And then it still leaves 20% for some of these more diversified, think your aerospace and defense names that are still major players in space, but that's not the majority of where they're getting their revenues from. So it gives you a really kind of interesting perspective of the companies that are deriving significant amounts from the actual theme in the name of the fund, space.
So I guess the biggest difference between the two is your fund is, as you said, companies that are today deriving revenue from space, as opposed to the ARK Invest fund, which is more so companies that we think one day will get revenue in some way, shape, or form from space.
So I saw it actually a really interesting puff piece by the Wall Street Journal today that was actually covering the topic.
Okay.
And an actual ARK employee was quoted as saying that their definition for space exploration and innovation is anything above the ground. And so that is a very wide interpretation, but could certainly help people understand why maybe some of the holdings are in there are justified from their perspective for being in there. And if we could turn this into a GIF of some sort, space is anything above the ground. That's not space. There's a reason that the Air Force is called the Air Force, and that they created a separate branch called the Space Force. So, many people will probably disagree with that definition, but that is, could help people understand the ARK interpretation for space. Another important change there as well is that it's not just the space exploration ETF, as many have called it. It's the space exploration and innovation. And when the SEC looks at names for funds, they take a lot of things into consideration. Innovation allows for an extremely wide definition of what kind of company could be defined as an innovation company. And so therefore we have certain mandates, and ARK also has their own mandates. Ours just are very different. So that could certainly lead to why from the last calculations I had seen, there's about 24% overlap between UFO and ARKX. So someone could certainly have both holdings if they want some space exposure in their portfolio with not a ton of overlap. Interestingly enough, ARKQ, another ARK fund, actually has more overlap with ARKX than UFO does.
And you know what else is interesting is the announcement from ARK didn't just drive assets into UFO, but it indirectly drove the fund itself higher because people were speculating on stocks they were going to buy, which were also stocks that UFO owns. So it indirectly drove UFO higher in a weird way. I have up on the screen here sort of the main, I guess you can call it baskets within UFO. Satellites, telecom, space tourism to the extent that exists. I want to start on satellites or for a second, because it's a very interesting concept where it's getting more affordable to ship stuff into space and to get stuff off the ground and to launch materials, equipment, whatever. That's all getting cheaper. So you might hear that and think, well, wait a minute. If it's getting cheaper, why do I want any part of that? Explain why that's not the right way to think about it.
It is breaking down the barriers of entry to companies that want to engage in space. Companies that hadn't ever even considered expanding their business into space or increasing their capabilities because of the higher cost to entry are now able to come to the table with their new ideas and technologies. And so you look at things like 5G, cloud computing, Internet of Things, connected devices, big data, even cryptocurrency and blockchain, and people are investing tremendous amounts into those different themes. But if each of those themes are to be successful, there's a common thread, and that thread is data. And data needs to be sent from point A to point B in many of those examples. So if we're truly going to see an explosion in the amount of data that's being created, Satellites are going to be a critical part of that infrastructure, as they already are today. So we look at satellites as kind of the digital data superhighway toll operators. And why also launch costs coming down, reusable rockets, something that SpaceX has been getting a ton of fantastic press from. They're helping drive down the costs. And it's not just satellites. When NASA now wants to send astronauts to the ISS, they no longer need to rely on Russian capabilities. SpaceX is doing it and saving them nearly $30 million per seat per astronaut on each of these. So if you think about the amount of budget that could free up for a group like NASA as well, they can now reinvest that budget into other areas. So the cost of access to space coming down is truly opening up the commercialization of space in our perspective.
I don't want to lose track of the chat. There's a few questions in there, so I'm going to ask one right now. Someone had asked about here it is. What are your thoughts on a number of the space SPACs that have launched? I don't know if UFO owns any SPACs. Does it? And what do you make of just what appears to be a decent number of companies entering the market via the SPAC route? Space companies entering the market via the SPAC route.
So Virgin Galactic, I think, is one of those examples of a successful de-SPACing.
Right.
To be determined how well the company will do, how quickly they can hit on their timelines. But certainly that showed that there is a significant interest for investing in space. And these private space companies historically have had very difficult times accessing capital, aside from your SpaceX's, in your Blue Origins, which are predominantly funded by Jeff Bezos. And I think it's extremely great for the space economy that now we can see these private companies having the critical ability to access capital that hopefully can help them take things to the next level. That said, not all SPACs are created equal. We don't know necessarily what the visions of these companies are now that they're going to hopefully be able to access capital. At the same time, some of these companies have government and military contracts as well. So whereas in many SPACs, you kind of just need to get the shareholder approval to complete the merger, there could be some additional layers that could potentially block some of these companies from successfully de-SPACing. And because until a company finally truly de-SPACs, there's not really a guarantee that event will occur. The underlying index that our fund tracks doesn't include SPACs. It does have the potential, though, to include de-SPAC companies, which is why you saw Virgin Galactic was actually pretty quickly added into the underlying index after the de-SPAC. That's not so not saying that these SPACs are bad deals or good deals. If they de-SPAC successfully and they meet the underlying criteria required for eligibility in the space index that we track, then they could certainly make their way into the fund as well.
What would you say is like the general type of company in UFO in terms of like life cycle? Like where are these companies in their life cycle? There are obviously some very mature ones, and there may be some that aren't as mature. Can you break that down for us?
Well, I think that's one of the exciting things about the composition of companies. You do have a very wide range. You have your companies that are very early stage, like a Virgin Galactic, that are still working on their R&D to do things like space tourism, hypersonic point-to-point travel. But then you also have some of these aerospace and defense companies who have been leaders in the space industry for decades and have been getting government and military and NASA contracts for years. So it is truly a wide range. But if you're looking at breakdowns, though, one area that you'll see a pretty decent exposure, like you said, is satellites, and that's because communications and broadband internet are major parts of the space economy. The space economy, the last number from the space report reflected 2019's number. We're still waiting on 2020, but 2019 was roughly 420 billion. And you look at groups like Morgan Stanley, who predict that the space industry will grow to over $1 trillion by 2040, and Bank of America that believes that the space economy could be roughly $2.7 trillion annually by 2045. And if you look at how they derive those numbers, they too believe that communications and broadband internet will be the major drivers for that growth. And currently, roughly a third of the commercial space industry is coming from broadband internet and communications. So that's something that UFO is providing a pretty large percentage of its exposure to currently, on the IT, communications, broadband internet. And it's a lot of stuff that you're actually not getting in other portfolios. So this is providing, in many cases, new exposures for investors that are looking to add UFO as an additional exposure to whatever else they're holding.
Andrew, I wanted to ask you quickly about the growth of the fund in terms of AUM. Where are you at right now, and is that ahead or behind sort of where you thought the fund could be 2 years in?
Yeah, space is something that people are just waking up to realize how critical of an industry it is to our everyday lives, not just as individuals, but from a commercial level as well as from a government, military, and defense level. And so, I think I had certainly hoped that people had understood the importance of the space industry and what it was. But sometimes it takes unknown catalysts like an activist investor announcing that they're bringing a fund following that theme to market to bring out the awareness. So certainly we think space is a much bigger idea and industry than the 130 million in AUM that's currently invested in UFO, and that's part of our responsibility to make people aware. And so we certainly appreciate programs such as yours that are asking a lot of the harder questions about what is space, where does it belong in people's portfolios, and helping shed that awareness, because it is something that is so important and in many cases a really misunderstood industry.
You have unusually good timing, I think, when it comes to the launch of new products, because this was launched when, April of 19, right?
Yep.
And that was what, 2 months after the Space Force was signed, the U.S. Space Force, I think.
It was right around that time.
Yeah. So again, and these things can't just be spun up quickly. So you sort of had that tailwind at your back. And then you also launched your first ETF was Hack. You launched that right before there was a massive data breach at Sony, right?
So that was actually the fourth ETF I had sponsored. But it was launched about 2 weeks before the Sony breach. Exactly.
What? How do you explain that? I mean, and that obviously helped Hack grow a lot in terms of assets. It's no longer the largest cybersecurity ETF by assets, and you're no longer involved. But at the time, I mean, the timing was unusually good, and it seems like this time you've also had unusually good timing. I'm not sure what you make of that.
So, I think everyone says you'd rather be, however many days or years early than a day late. And for me, one of the things I try to do is find themes that are in their earlier stages that I believe investors want to have exposure to, that are these longer term themes. And for whatever reason, many larger shops aren't looking for that. They're looking for more your core exposures and things like that. Whereas we're trying to find ways to create new investing opportunities for individuals that aren't really in the market, providing new holdings for them as well, giving them global diversification. And I think if we're able to continue doing that, hopefully following that model, hopefully we can also bring many other first to market themes that hopefully are what investors are looking for. Yeah,
another one from Chad here. How often is UFO rebalance?
It's rebalanced quarterly, reconstituted semi-annually.
Okay, so twice a year. That just means twice a year that you're adding in and removing, right?
Yep, and certain exceptions can be made as well in there, but typically, yes.
Sure. That kind of, honestly, that exhausted the list of my questions. I'm sure I'll think of more after the fact, but I really just want to get you on to talk about the growth of the fund this year, because you've had an unusual year. We've gone from 0 to 2 space ETFs in the span of a couple of years now. I guess, do you anticipate more, or do you think you've got enough of a head start and ARK has enough of a brand that between the two of you've got the space ETF thing locked down?
Every time I bring out a great idea, we have always more and more competitors launching those products, whether in the US or abroad. I certainly believe in the space industry, which is why we brought this out as our first product. It was really important to us. And we're looking to do a lot more around the space theme beyond just ETFs here in the U.S.
Really?
And so it's something that we believe in. But we're also not just married to this one theme. So I would certainly not be surprised if others continue to follow in my footsteps and launch competing products. But hopefully people see the incredible amount of work that was put into building out this index, and hopefully they'll need to find another one.
Wait, when you say you're looking at other products, are you talking about other types of assets, or just other markets like outside the U.S.?
Everything under the sun.
Everything. Other securities, other markets, not just an ETF here in the U.S. Andrew Chanin is the co-founder and CEO of ProcureAM, the sponsor of the Procure Space Etf, ticker UFO. Andrew, always a pleasure, sir. Thanks a lot.
Thanks so much for having me.
All right. Thank you very much, Ruth LeMay. I appreciate that. Smash the like, guys, for Andrew and for space. We're going to the moon, literally. I hope one day. I don't know if I'll be the first in line, but I'll be in line, somewhere in line. I don't know if I'll be first, but I'll be somewhere in line to go to the moon whenever those things, whenever Richard Branson decides to let everyone in. Okay, I do want to go back to my quarter in review. Thanks a lot, Andrew, for coming on. I talked about which ETFs saw the most inflows last quarter. Let's talk about which ETFs saw the most outflows last quarter. So I'll bring up my Benzinga Pro here, and let's go to the outflow list. Again, there isn't too many surprises, but I think the themes are important. Number one, LQD, big fixed income ETF, the iShares iBox US dollar investment grade corporate bond ETF. About $10.5 billion went out of LQD last quarter, and you guys obviously know why, right? Bond yields went up. They're actually lower for the past couple of days here, but bond yields went up. That was a big theme of the quarter. The inverse correlation between bonds and stocks, and with interest rates so low, there really isn't much of an incentive to own bonds. So it's not a real surprise to see LQD see this amount of outflows. Number two, if LQD lost about $10.5 billion, GLD lost about $7.5 billion. I will note that both of these ETFs are also very commonly used as trading instruments. So the AUM figure may not be always indicative, because these are both widely traded, used by active traders for hedging and that sort of thing. So it's not as if everybody who owns these things is owning them to buy and hold and selling them to get out permanently. They're not. These are also trading instruments. But that being said, gold has, as you can see, been punished dearly. Didn't quite perform. Definitely wasn't a hedge last spring, right? You guys, you see that dip right there last spring. Gold did not protect you from the sell-off last March and last April. GLD getting a lot of outflows last quarter. Number two on the list. Number three. This one's interesting. USMV, the iShares MSCI US Minimum Volatility Factor ETF. What does that mean? First off, what is a factor ETF? Factor just means characteristic, okay? You have factor ETFs will screen for different characteristics of securities or of stocks, okay? Whether that characteristic is volatility, whether it's value, whether it's growth, whether it's dividends. There are so many factors that you can screen for, and there are a lot of ETFs that provide exposure to these different factors, right? So this one is an ETF that provides exposure, supposed to provide exposure to a basket of U.S. stocks that have minimal volatility, very low betas. This one lost about $5.5 billion in assets last quarter, which is about 20% of its overall AUM. So that was number three on the list. Number four, sticking with the theme, fixed income, HYG. I think this is the largest. No, it is not the largest bond ETF, but it is up there. Same story as LQD, right? Bonds out of favor. Lost about $4.5 billion in assets last quarter. QUAL. Another iShares Factory ETF. The last one was for minimum of all. This one is for quality. And there's a whole screen. There's a whole screen that they have that iShares has, or MSCI, I guess, has, that they screen for quality stocks. People don't want quote unquote quality stocks based on their screen. QUAL lost a little under $3 billion in assets the last quarter. It's about a 15% of its total AUM. Next, SPY, again, trading instrument. There's really no rhyme or reason for SPY being high on the outflows list, and VOO and IVV being on the inflows list. Again, this is a trading instrument, so I wouldn't put a ton of stock in that. Next, XLP. Interesting. Consumer staples. The State Street Consumer Staples ETF lost about $2.5 billion of outflows last quarter. It's about 22% of its AUM. Very interesting. Let's look at the top holdings in XLP here. I'll go back to my ETFDB, and eventually we'll have all this stuff in Benzinga Pro, by the way, so I don't have to go here. But for the meantime, this is a site that I like going to on the regular. Obviously, this is like boring value stuff. A lot of this is value, right? Look at Coke, Procter & Gamble, Pepsi, Walmart, right? Altria Group, Mondelez, a lot of food stocks, defensive stocks. Look, consumer staples. So anyway, this fund lost about $2.5 billion last quarter. Interesting, because it is more of a value play. So it was. I was surprised to see it on the list there. Next one, again, sticking with that theme, Treasuries, TLT, your most actively traded bond ETF that I'm aware of. Lost about $2.2 billion in outflows last quarter. Not a surprise. JNK, your junk bond ETF, also on this list, lost a little over $2 billion of outflows last quarter. And SHV, that rounds out the top 10 ETFs with the largest amount of outflows last quarter. SHV lost about $2 billion in assets in the first quarter. If we can zoom out for a second and look not so much at specific funds, but look at just broad themes. I mentioned U.S. equity. U.S. equity was the largest, or the most popular, I should say, the most popular subset of the ETF universe last quarter. U.S. ETFs, U.S. equity ETFs, I should say, took in about $120 billion of new money last quarter. That led the way. A lot of people buying into U.S. equity funds, U.S. stock funds, by far the largest amount, the largest of any category there. Again, $120 billion of new money coming into U.S. stock funds. About $82.5 billion came into international stock funds. So you see U.S. stocks, you see international stocks, 1, 2 on the list. What does that tell you? A lot of people are bullish stocks, right? U.S. stocks, international stocks, doesn't matter. There's cash on the sidelines. People want in. They've been saving. There's been money coming from the Fed. Interest rates are low. People have demand for U.S. stocks, or no, all stocks really, but U.S. stocks in particular. Not a real surprise to see those 1, 2 on the list. U.S. equity stocks are pretty much always, or U.S. Equity funds are pretty much always at the top of the list in terms of inflows. What was interesting to me is commodity funds, and I just showed you GLD, which lost money last quarter. Commodity funds lost about $6 billion as a group last quarter. A lot of people pulling their money out of commodity funds, whether it's gold, silver, oil, whatever. A lot of outflows in commodities. That was actually the only group, the only ETF group, as whatever you want to call it, asset group, to have outflows last quarter. If you look at stocks, you look at commodities, you look at currency, you look at alternatives as the main assets. Only commodity ETFs saw outflows last quarter. Very, very interesting. So it wasn't just GLD, though a lot of it was GLD. Gold, silver, copper, oil, ag, outflows overall. So very, very interesting. I do want to look at, this isn't going to be quite lined up with the with the end of the quarter stuff, because obviously we're on April 8th now, or April 7th, but I do want to go to a screener and just show you the biggest ETF gainers in terms of returns for the year. And I am going to include leverage funds for this, just because. We've talked about this previously. Let me bring up my screen here. We've talked about this previously. BDRY. This thing was a monster. I don't know why it was going up the way it was. This thing is a little bit confusing. It owns, shipping futures. So it's a bit of an alternative in that sense, but look at the performance year to date. Massive gainer. Your best performing fund year to date is BDRY. Please, please, please don't just chase performance, but it's worth it to know these things, I think. It even outperformed a leveraged retail fund. And this one owns GameStop, RETL. So that was interesting. So RETL was your direction, daily retail, 3 times bullish ETF. So daily retail exposure or daily leverage exposure to retail magnified by a factor of 3. So you get 3 times your exposure on any given day for retail. You see that spike. That was GameStop right there. So GameStop does account for a lot of this, but it's not the only, it's obviously not the only holding. So RETL was your number 2 best performer in terms of just return. Again, that's a leverage ETF. It is not meant to be held for more than a couple of days or even a week at a time. I would not recommend that at all. I am keeping leverage in the screen just because. And look at this. We talk about energy. I was talking about that yesterday, I believe, on the show. Energy, the micro sectors, U.S. big oil, 3 times leverage ETN. This is not an ETF. This is an ETN. There is a difference. An ETF, an ETF is a security that holds a basket of assets. An ETN is a debt instrument. It provides exposure to big oil. Let me zoom in. It provides exposure to big oil, but it does it via debt. In this case, the issuing bank is the Bank of Montreal. So that's a risk. This security, this ETN, is subject to the creditworthiness of the underlying bank that the debt is through, which is BMO. It can operate like an ETF. It can provide the same exposure, but it is a different type of asset altogether. And you really, if you don't understand the difference between ETNs and ETFs, don't trade ETNs. That's what I'll say. Understand what an ETN is and how it's different from an ETF before you trade it. Obviously, a lot of the biggest gainers are going to be leveraged funds. These are all leveraged, right? DPST is your original banks. Nail is your home builder. Let's look at Nail. That's your leveraged home builders fund. Okay. Obviously, the housing market is in a gigantic squeeze right now. There is way too much demand, not anywhere near enough supply. This is your home builders ETF. And it's just crushing it. They literally cannot build these homes fast enough, and I'm getting squeezed out of the home buying market. So it sucks for me. But that's very interesting. That Nail was. I'm not surprised. But we've all seen this trend happening in the real estate market right now. Look at Gush. Right, is your oil and gas 2 times leveraged fund. Look at, this is interesting. The S&P High Beta fund from Direction was up big last month or last quarter. Here we go. Let's get away from the leverage. Enough leverage. Look at this. Tim Seymour's Cannabis Fund, CNBS, up 66% year to date. There's your blockchain ETF, BLK from Amplify. Trying to get them on the show. You got cannabis. You get blockchain/crypto. More cannabis. There's your biggest gainers for the quarter. Cannabis, shipping, blockchain, and leveraged products from Direction. The model there is pretty good actually for these guys. They're pretty much always going to make money because they have leverage and inverse funds. So they're always going to have a fund going up a lot in any market. Year to date, let's look at the biggest losers. Oh my God, we got to skip all the way past. Here we go. Biggest losers, again, this is going to be leverage. It's going to be all leverage funds. You can see energy bear fund, the opposite of the high beta. This is your high beta bear fund, right? Financials bear fund, semiconductor bear fund, down 53%. These are all leverage funds, not meant to be held for long periods of time. And you can just see, right? Bullish funds did well, bearish funds did not. That's typically how it goes. Although if you go over a long enough time horizon, your bullish funds don't do well either because of the nature of daily resetting leverage. We've gone over that before several times, but let me see. Let me just, for the sake of this, actually, let me just get rid of the leverage here, just so we can get a better view on what didn't perform last quarter. So a lot of VIX related funds. The VIX is obviously on a steady decline downward, so no real surprise there. Look at this. This is a new one for me. ProShares Decline of the Retail Store. That's the name of the fund. The name of the fund is Decline of the Retail Store ETF. All right. That's a new one for me. EMTY. Empty. These guys are good, man. That's funny. Empty is not looking great. Great hedge last year, but I don't know. This is like the anti-GameStop trade. So, I never heard of this fund before right now. EMTY. It's funny. It's an interesting concept. What else do we see as the biggest losers? They're all going to be bearish funds and treasury funds. So, yeah, that was kind of it, guys, as far as my year in review. Yes, CR, thank you very much. Smash that like button, guys. Let me get to the chat here. What is the blockchain ETF? Brian Blockchain, you don't know. Brian Blockchain doesn't know what the blockchain ETF was. Then that cannot be your name. BLOK, Brian, BLOK is your Amplify blockchain ETF. Kyle Walton, will you section out your interview with Andrew later? You missed it. Kyle Walton, we will section out this entire show, actually. So you can just rewatch the ETF show by itself. That'll be after the show is done. I'm going to cut that out. Let me catch up on chat. You know what I haven't done actually for a while? Let me show you guys my ETF list. These are the ETFs that I currently own. And I'll have to zoom in for you. Here. All right, these are my ETFs that I currently own. I have a pretty good tolerance for pain. If you recall, about a month ago, I was looking for an infrastructure fund. I haven't actually pulled the trigger on anything yet. I'm very deliberate and patient when it comes to ETFs. I don't make decisions rash decisions. So I haven't bought anything new for a hot second. I should mention, I do own a very, very small position in UFO. It was the most recent thing that I've bought. It is basically the smallest position of any ETF that I hold. And as I mentioned at the top of the show, VOO is my largest position by a lot. It's about 40% of my portfolio. VEU is the second largest. The rest of these are all like strategic thematic funds. They're all obviously high growth, and growth has gotten beaten down. ARKW still holding. KWEB still holding. SPAC ETF still holding. Getting beaten down, but I can take it. All right, you got to know what your pain tolerance is, and I know that I can take the pain in these. So I am not panicking. I saw someone mention KWEB earlier. Yeah, it's gotten crushed, but that's what KWEB does, though. If you want to go to a chart of KWEB, this thing gets crushed sometimes. You have to know that going in. Zoom out. I mean, like, look at 2018, right? This thing was range bound for years. Just broke out to new highs last summer. Took long enough. So, I see this, and I look at it within the context of this. And I just see, okay, we're at new all-time highs back in December. This thing was breaking out way, way, way out of the range from where it had been trading. So I expect some kind of a pullback. It looks like we've bounced awful low for now. My bogey is always going to be, either a certain percent from my cost basis or like a key level. In this case, the key level was like the $65 area. So, obviously this sucks to be long a fund that, that you owned it at 100 and now at 76, but I can take it. So I stay away from the 2 to 3 times leverage. They're great trading instruments, Logan. I would never, ever invest in a leveraged fund. Why? Because they tell you that's not how they're supposed to be used. Direction, ProShares, they will tell you, do not buy and hold these funds. That's not what they're for. They're for trading. I would absolutely trade them. I would hold them for a couple days, maybe a week. I would not buy it and then forget that I owned it for 6 months. That is a recipe for disaster. Oh man, it is 2:58. Time flies when you're having fun. Any other questions from chat that I can get to? I feel like I don't do a great job always of keeping an eye on chat during the show. So I got to get better at that. I'm not as good as Neil Hamilton, that's for sure, as far as chat's concerned. We're about to debut, premiere our next episode of First Trade in a couple minutes. So that'll be up next on this stream. So as I said this morning, we're doing separate streams in the morning and then one long stream in the afternoon. So this stream will continue for the rest of the day. Let's see. Do you trade very much or a mainly investor? So I have different accounts, right? In my Fidelity account, I mainly do investing. Okay. I'll any swing trading that I do is going to be in my Webull account. So, and I kind of keep those separate. I don't really trade ETFs. I'll trade stocks, right? I'll trade a stock. I'll hold a stock for a day, for a week, whatever. Any ETF that I buy though, I'm buying because I want to hold it for a while. I want to hold it for like a year or more. So, and that's just kind of sort of how like my behavior is. I look at ETFs as more of a buy and hold thing, and I will buy and hold stocks, but I will also trade stocks. I try not to trade ETFs unless you're leveraged, of course, or inverse, in which case they're meant to be traded. But as a general rule, I try to not trade ETFs and keep my trading on stocks. I have a much shorter leash for stocks than I do for the ETFs. Why? Because they're more diversified, and I feel like over time the diversification will only help you. Solar up and up. Good point. Solar up and up. It's like, why would you air first trade during the day? Yeah, you're not totally wrong. Solar. I'll have to pass it along to the powers that be. Logan and Reed hopped into DFEN for a few months. I'm curious how that worked out. I'm genuinely curious. I'm not trolling you. I would love to know how that worked out. WCBR for a cybersecurity ETF. Yeah, Coupon Boy. I know that one. I don't own that. I own CIBR, but I am familiar with WCBR. I looked at that one when I wanted to buy it. I looked at Hack, settled on cyber, but yeah, it's a solid fund. The exposure is a little bit different, but it's a solid fund, no doubt. Okay, that being said, producer Rohan, are we good to go on First Trade?